what's going on with the markets right now. Suyash Choudhary joins us on this conversation. Suyash, good having you on the show. Let me begin this conversation by asking you about what bond dealers are telling us, that you are seeing long-term investors, long-term foreign investors interested in Indian G-Secs, particularly at the long end of the yield curve. How are you reading this and what's going on?
So, that's exactly right. I would think, there are two elements to the market. One is the so-called structural trade, and the other is the positional trade. Now, on the positional trade is where there is a headwind, both locally as well as globally. So, you just described the global environment as well. If you look at especially Germany, that has been spectacular. From 7 basis points, they went to 77 basis points and have retraced now to, I think, somewhere in the mid-50s. But again, and this includes India as well, there were a lot of one-way long positions. So whether it be developed market yields or let's say Indian assets, and those are in the process of getting adjusted a little bit, basis some near-term triggers, the one key one being higher oil and some bit of reassessment of on-the-ground development as far as India is concerned. Having said that, if you look at the structural themes, they continue to be the same broadly as they were, let's say, a month and a half back. The only two reasons to worry one can have is the 30-35% rise in oil from the low. And in terms of concrete data, we have seen some uptick in US wage costs last quarter. So, some may take some cause of worry from there. But barring these two, it remains a world of low growth, low inflation. India remains a structurally strong story as far as bonds are concerned, because the one variable that we are tracking closely, which is inflation, continues to fall. And like you mentioned, the next reading market thinks will be sub 5%. We are actually closer to 475, which means there's a good undershoot of 50 basis point from the RBI's latest assessed trajectory. So I would think the scope for the next 50 basis point of rate cuts is very much intact over the next 6-9 months, and for that reason, if nothing else, bonds continue to be a good long-term story.
Okay, I just want to push that point just a little further, Suyash. If FPIs are interested indeed in the local bond story, but the data for the last couple of weeks, at least for the last 1 week, suggests a $400 million sell. How do you think both these sit together?
So there is a positional unwind in play, like I mentioned, and some FPIs would be choosing to tactically unwind at least. The one surprising aspect has been the government bond selling by FPIs for 2 days, because as we know, government bond limits are hard to come by. So, that bit of selling could be of a more medium term nature, but the shuffling that you're seeing on the corporate bond side, I would think is purely tactical. FPIs may be taking a view that they may get yields higher by around 10-15 basis points, or currency weaker by let's say 50 paisa or so, but I don't think the mood is to really exit India, or put it another way, I don't think there is a structural shift in the way either India or the rest of the world is getting perceived right now.
Suyash, how does a weakening currency fit into all this? Because on a dollar basis, the equity market at least is one of the worst performing Asian markets on a year-to-date basis. How does a weakening currency affect investment into the debt market? How does that play out?
Till 2-3 weeks back, we used to worry that currency is too strong. In fact, on an RER basis, we were overvalued in excess of, I think, 11 to 12 odd percent. Even with the recent correction, we are still overvalued by 8 to 9%. So really, I don't think the direction of the INR is a worry. It's the fact that it's happened in a very short span of time. So volatility around the INR has risen, which obviously in the near term will not go down well with foreign investors. Having said that, if you even have a 3 or 4 year view on Indian bonds, you wouldn't expect the currency to depreciate by more than 2 to 3% per annum unless there is a massive global risk off event. So I would think as long as INR volatility is contained in a 3 to 4% band, FPIs will look or continue to look bonds favorably. And bear in mind, bond volatility that we see in India is maybe amongst the lowest that we see around the world. So if you look at developed market yields, the way they swing off a very low base, and if you look at India, we swing 15-20 basis off an 8% mark. So volatility is hardly there. So I think the interest remains quite intact for medium term players.
What should a mutual fund investor be doing right now? he's seen the market correct, the equity market correction over the past couple of weeks. You are seeing sudden interest in bonds. Do you see interest coming back to fixed income for the second half of this year?
Well, the interest on fixed income remains intact, so I won't think that interest has dissipated. In terms of flow, yes, flows have certainly slowed down in the last couple of months as bond yields have kind of stagnated and risen recently. In terms of advice to investors, the two things we are saying is hold a core long bond portfolios chiefly dedicated to government bond assets, for the simple reason that if India is indeed in the midst of a structural breakdown in inflation, and if the RBI and the government actually succeed in anchoring inflation to 4% by 2018, then there is lots on the table still for bond investors. So if this were to happen, it's a very good trade even now. If it doesn't, then the market should allow you a reasonable exit opportunity in the next year or so. The other thing we are saying is be cautious on credit risk, because the environment globally as well as in India is one of weak growth and excessive cross-asset volatility in the midst of very high leverage in the private corporate sector. So this is not an environment where one should be taking on too much credit risk. So a combination of good quality short-term and medium-term instruments as well as long sovereign as a core part of the portfolio is what we would ideally tell investors to look at.
Suyash, I want to ask you, how does government schemes and the high saving rates that they're offering on schemes such as Sukanya, which is tax-free in nature on one side, which is already having a face-off with how the ability of banks to cut deposit rates any further. What impact do these high savings rate on some of these government schemes have on inflows into the debt market as well? Does it hamper the interest into fixed income mutual funds?
No, not much, because I think one, there is a limit to how much you can allocate under those schemes, and two, the segments of the market that are involved in these two respective instruments is slightly different. So I don't think inflows into debt really get hampered. In fact, one of the key points we have been making to investors over the last year is now you can beat inflation in India for the first time in the last 5-7 years by simply holding a 10-year bond. And any other asset class that you choose no longer needs to happen only because of the mandate of beating inflation. So I think that holds. The other point about bank deposits, I would think banks as an intermediation channel across the world are shrinking, because other means of credit, other means of borrowing as well as other means of funding are taking kind of strong hold. So the same trend remains in India. Both credit and deposit aggregates are falling. And I believe that any uptake ahead will also be modest on this count as far as the banking sector is concerned.
One final question, Suyash. Yields currently are close to 8%. This is a far cry from what, 7.6, 7.65 in February, March. This is despite the 25 basis point rate cut that we saw. I also understand there's going to be a new 10-year that's coming in early next week or something like that. How do you then see yields behaving in the next few months?
So the context is that we have come from 9%. So from 9 to 765, and then a 30-odd basis point correction is kind of par for the course, because the very fact that markets are driven by a lot of financial flows now tells you that there is going to be some bit of volatility. Having said that, the RBI is on a clear inflation plus real rate model. So as long as your CPI forecasts are intact and RBI sets a real positive rate of 1.5 to 2% is what they are saying, I think there is scope for further rate cuts. The key structural local trigger that we are looking at is the government's continued response to food prices. So if the government continues to provide comfort to the market that their food management is good, and it has been so far, and therefore food inflation remains contained, I think the structural bond story in India remains intact. As far as the new 10-year is concerned, it will debut somewhere around 15 basis lower than the old 10-year, and over the rest of the life of that asset, the two will converge. So we personally are not big chasers of new bonds per se, but the outlook on the debt market seems quite okay with a 6 to 9 month view.
Interesting. Thanks indeed for joining us today, Suyash. That's a view from IDFC Mutual Fund talking about fixed income, and perhaps that's where the next flavor of the season is. All right, coming up next.